Welcome back. We're still focusing on markets in April. I've been talking to Johnson Chukwu, Chief Executive Officer of Carrier Asset Management Limited. Now, we're still talking about those earnings, key market drivers for the month of April. Now, still on investors' investing behavior, we did see a lot of speculative trading in the month of April. That's why we saw the all-share index struggling to break that 33,000 psychological level. Now, investors, I spoke to one or two stockbrokers, and they said investors, many of them seem to be taking a short-term view. They just want to come in when stocks rally for 3, 4, 5 days. They just come in, take profit, and then exit. And we see the all-share index taking one step forward, sometimes 2 steps backward.
You see, the way I would see it is this: in the month of April, or starting from towards the end of March, the prices of equity had priced in the expectations of investors. You see, the reality what happens in the market, that when you're investing in an equity, you're actually investing in this future stream of cash flows from that company's results or earnings. So what investors do when they want to speculate is this: investors will say, speculate, for instance, what do I expect, what kind of dividend return do I expect from GT or Zenith? And then if you make your own expectation or estimation, you then take a position looking at the current price, the price of that stock at that point. Then when the price has mirrored all those expectations, a speculator will exit. So normally, between the months of February and end of March and early April, investors take positions in stocks based on expectations of publication of results. By the time the results are published, those who are holding off for speculative purposes will exit. It's either the objective has been met or has failed to materialize. So they exit. It is different from those long-term investors. Speculative investors are looking at returns. Either you're looking at cash dividend return, scrip dividend return, or capital appreciation, short-term capital appreciation. And you take those positions when there are excitements around that stock, particularly if the company is about to publish results. So if your expectations are met, or if your projections are realized, you find that you make either capital gains or you collect your dividend and exit. So I expected that the month of April will actually see a lot of speculative investors exiting market, because the next option, the next result season will be either half-year results, when a few companies actually declare interim dividend. Then you actually have to wait for the next end of this year, which speculative investors do not have the time to do. So speculative investors are looking for opportunities, and what happens that the price have stock prices have moved up towards the end of last year. We saw huge capital appreciation in the last quarter of the year, to the point that the market closed at 5.454% at the end of December. And then at the end of the first quarter of this year, we saw stock prices touching above 20% capital gain, all-share index. And for investors that are looking for short-term capital gain, it was a window to exit. So that was expected. If you actually understand the market, that's actually a natural market trend. Natural market
cycle. Because I was asking, a stockbroker that calls regularly on the program, and he said yes, it's actually good for the market. But I couldn't help wondering if that would affect the long-term investors who are the market. I mean, every day they see the stocks, they look at their portfolio and they see some of the stocks that they've invested in, losing value, sometimes appreciating value, and just that seesaw continuing.
No, for the long-term investors, any good long-term investor knows that the market will go through with some level of oscillation along the period. But in the long run, if you see, the market is still doing close to 20%, maybe about 70%. It has not dropped. I mean, it hasn't dropped negative. So you find out that, look, what happens because of those oscillations, the growth is actually incremental. But in the long run, what matters is what you get as overall return on your investment, and not necessarily the oscillation. So the long-term investor, along the line, those oscillations will smoothen out, and ultimately you still have an upward slope.
Okay, let's move on to the regulators and market regulators, starting with the SEC, the Securities and Exchange Commission, and still tied to this dividend payment. It's still AGM season, the season where quoted companies pay out the cash dividends and bonuses to the investors. Now, the SEC says that the number of unclaimed dividend has actually ballooned. 60 billion is where the SEC puts it right now. So it's trying to scrap that dividend warrant, and has asked shareholders of these quoted companies to send their bank account details to their respective registrars and stockbrokers, and that by June 3rd, that was the deadline the SEC has said, it will scrap those dividend warrants. But then there have been several mixed reactions, more of complaints than accolades for the SEC, saying that, look, the time frame is perhaps too short. I spoke to Rotimi this morning, and he said that perhaps this is something that ought to have happened way before now. What are your thoughts on that?
For me, the key thing that the SEC needs to do is to create a lot of awareness. They should be on the radio, on television, on the newspapers to drum up awareness on the need to scrap, the plan to scrap paper dividend. You see, the truth is this. A lot of investors that invest in small stocks, small volume stocks, hardly seek for the investment dividend. They don't bother to know that the dividend has been declared. Retail investors are not as savvy in claiming their dividend as institutional investors, because sometimes their unit holding is so insignificant. A friend of mine came to my office on Tuesday and said we called him to come and collect his dividend. He asked for the amount, and maybe the amount was something like maybe 50-something naira. And he looked at it, driving all the way from Ikorodu to come to VI, or do we send a dispatch person from VI to Ikorodu to go and deliver a 50-something naira dividend? And the only option was, give us the account number, account details, so that we can go and pay it. But you see, the inconvenience of us receiving the dividend, the postage cost of bringing that dividend to our office from the registrar, and us mailing it to him, or sending someone to go and pay that money, is
perhaps
higher than the amount he's going to get. Sometimes the dividend could actually be 30 naira, 20 naira. But if you have a straight-through settlement, where the dividend warrant is paid straight into the individual's account, it doesn't matter whether it's thinkable.
So long as it doesn't go through the hassle of getting it.
Yes. So the problem is that the cost of delivering or dispatching dividend warrants is, in some instances where retail investors are concerned, more than the value of the dividend warrant. And that's why you're having a build-up. Of course, because these amounts, though these amounts are small, but they accumulate. The cumulative effect of those small amounts is what has summed up to 60 billion. So if we recognize the fact that, look, if you have to keep the interest of retail investors in that market, and because you cannot invest in equities, in Nigerian equities with cash lodgement, you must draw from an instrument, a bank, which means every investor in Nigerian equities is assumed to have a bank account. You understand what I'm saying? So it just follows that if we create enough awareness, the investor should just go to his stockbroking houses, or send a mail to the stockbroking house and provide the account details. The stockbrokers will send those to the registrars. And that will reduce significantly the issue of dividend warrants. Because a situation whereby investors are not getting their benefit, and those pool of funds are lying with the registrars who are trading with those funds at no benefit to the investors.
The money to the registrars, not with the companies, because there was also talk that some of these companies retain this dividend and actually the cash dividend and actually use it as part of their operating expenses.
If the company has an in-house registrar, they will retain it. If the company has an outside registrar, which is one of the policy reforms that we've seen recently, when companies are not supposed to use their in-house registrar.
But how do we know that? Because wouldn't this even distort what the financial statement is at the end of the day? How do we know that they're not putting that money back into running the business? You
see, the way it works is this. Money is fungible. If the money is not disbursed to shareholders and it remains with the company, it becomes part of their working capital. It lies in the balance sheet as a liability, but it's there as an asset, as cash. So somehow it will have a positive effect, because the company ought to have borrowed, they wouldn't need to borrow again.
But does that distort the bottom line at the end of the day?
If the amount is huge, it could enhance the company's earning strength, because it's not paying. That's an interest-free funding that is getting. When he could have borrowed at maybe 18 or 20%, he gets that money at no cost. So ultimately, it has a beneficial impact. Once you have any resource, any financial resource for which you're not paying a cost, then it has a benefit. So eventually, of course, it could lead to lower cost of funds or interest costs, and then a higher profit. But the basic thing is this: the funds that are not paid as dividend or that are not collected as dividend either remains with the registrars. In a lot of instances nowadays, they are with the registrars, or for companies that have in-house registrar, or before such companies handed over to an external